belief that some people have is that while we may be in a period of repression, and the West could probably afford it because of the nature of the economies and the balance sheets that they have, simply because economies like India, some of the other Asian economies are economies which need foreign funding and capital flows, they may not be able to afford it. And if they continue this policy of repression, it will eventually have a run on the currency. How do you see that? I mean, what are your thoughts there? And how do you see that in the context of what had happened back then in 97 as well?
Yeah, so the repression, I think when I try to explain it to anybody in the world what repression is, it ultimately takes you to a kind of licensed Raj situation, which everybody in India will be very familiar with. But funnily enough, you're more familiar with repression than the British are, the Americans are, the French are, because you had to suffer it more recently. So Indians intuitively grasp what that system is like. But we have to go back to why you would choose that policy. Now, my opinion, and it may be wrong, is that India will not choose it. The reason that you choose a policy of repression is because you've got far much debt relative to GDP, and you need to create a system where interest rates stay permanently lower than inflation. And that may sound fairly innocuous, but actually to get to that, you do have to you inevitably end up with a sort of licensed Raj situation. India doesn't have that much debt. I mean, its debt to GDP ratio is one of the lower in the world, certainly way below the developed world, and even by an emerging markets standards, it's fairly low. So my first position would be this, that every developed world country has to do financial repression, but India doesn't. And actually, there are very few emerging markets, apart from China, who do have to do financial repression. So the question is, if the West gets into financial repression, what is going to be the impact on India? That's the key thing. That's what we're really talking about. So where I would be mistaken is if India itself goes for repression, in which case I'd have to revise all my opinions. But if it doesn't and the West does, then I think obviously you're going to get higher inflation. That's just a fact. I mean, if the whole developed world is generating inflation, it is inevitable that India will get that somewhat higher inflation, and you have to live with higher inflation. My belief is if you don't believe in repression in India, interest rates are allowed to rise to reflect that higher. So that's not good for asset markets in the short term. That's a normal sort of cyclical situation where inflation is going up and interest rates are going up. But then we have this final caveat. In a world where interest rates are significantly and structurally negative in the West, people will be very keen to put money into India. I mean, the first rule of a financial repression is get your money out of the country. Now, it's funny, when I talk to developed world investors about that, they say, well, where on earth could we put it? We can't put it in Germany, France, United Kingdom, America. And I say, well, what about India? And they sort of laugh. And then you can see a little light bulb going on above their head. And they're thinking, well, wait a minute. It may not be the right answer, but it's something worth investigating here. If you are the only, and it won't just be India, there will be other emerging markets as well who do not do repression, you should be attracting a fairly significant amount of capital. So I know the reason why people are concerned about capital inflows into China, because we might try and restrict those coming out of the developed world. But the market force will be for money to flow from repressed regimes to non-repressed regimes. And as long as policymakers in India step back and stay away from repression, I think India will continue to attract. In fact, one of the problems may be attracting too much capital, at least for the first few years.
How tricky is the situation for EMs at large currently, considering that under the cloud of COVID-impaired economies, central bankers / governments have gone ahead paying little regard to fiscal deficits and higher fiscal deficits, and arguably the moves from rating agencies as well. Almost every other central banker that I read about or hear about says that it will be managed, doesn't matter, rating agencies won't act, and fiscal deficits are moving higher. Is that a risk, or do you believe that is manageable, considering that we are coming out of a COVID situation and economies will pick up sooner rather than later?
Yeah, so I'm not unduly concerned about that. And it depends where you start with on your debt to GDP ratio. If you are France and you're on, 374% of GDP, then, you've got a problem there if you're still borrowing too much, and even if your economy is growing quite sharply. But if you're an economy below 200% of GDP, which is where India is, then growth can get you out of that mess. This is the crucial thing. There are certain levels of debt to GDP where growth will get you out of it. And of course, we want that to happen as soon as possible, but the economies will rebound extremely quickly. But you don't have to grow at 8, 9, 10% to shift your debt burden if the debt burden is relatively low. So, I mean, I think the nice, easy example is Germany post the great financial crisis. And after about 3 years, its debt to GDP ratio began to decline, but it wasn't running excessively high levels of nominal GDP growth, but it just happened to have a debt to GDP ratio below 200. So I'm pretty confident that all of the emerging markets, or nearly all the emerging markets, with their debt to GDP ratios so low, will have a level of nominal GDP growth that means their debt to GDP ratios will start to come down. I'm not confident about that at all for the developed world because they're starting on much, much higher numbers. So we keep coming back to this debt to GDP ratio, and there's much, much more flexibility for policy. And then the final thing is, if the West is holding its interest rates really low, which I think it will be right across the yield curve, it does give emerging markets this opportunity to borrow at relatively cheap real rates. And that, you combine that with good growth and low debt to GDP ratios, then emerging markets are in a good position. And I don't get concerned about fiscal deficit being too big. And that can change very quickly once we get to the other side of this dreadful disease.
And every company or rather a lot of companies that I speak to in India, and I'm guessing that was probably the scene across the Asian hemisphere as well, everybody's talking about how there are global clients in the West looking at a China plus one strategy, coming to India, and I'm guessing going to the other places. And just a fraction of that investment moving out of China into some of these is resulting in great flows. Now, my question to you is this. You mentioned about how some of the investors in the West are, the light bulb going up and saying that, hey, let's look at India. Do you reckon that this time around, the EM pack and the Asian pack has that China plus one benefit, which could result in flows looking fairly strong over the course of the next 12 to 18 months?
Yes. It's a separate discussion, but there is a very, very big discussion, as important, if not more important, on everything we've discussed so far, which is what are the developed world's long-term relationships with China? And those relationships have clearly soured, and those relationships are already into capital. And we see that in so many ways, whether it's relationship with Huawei, which is a foreign attack on a Chinese corporation, or Ant, which is a Chinese attack on a Chinese corporation, with pushing in the US Congress to try and stop pension funds investing into the China. So this is becoming a capital war. And it is becoming increasingly risky for any developed world investor to invest in China in a capital war, because you can get these tit for tat movements, which means that the returns on your capital in China could be under attack. Even getting a return off capital can be difficult, but there's a risk associated with that, which we simply don't associate with India. I mean, we did associate that with India 40, 50 years ago, but we don't associate it with India today. And I think the contrast will be there and become clearer and clearer. And nearly all other emerging markets will benefit from the fact that China is not getting as large a capital inflow in portfolio assets, but probably more importantly in foreign direct investment. That foreign direct investment will have to look elsewhere. We'll have to look for shorter supply chains. We'll have to look for more robust supply chains. So I think, we talked earlier, if you like, about interest rate arbitrage money coming to India. People, discontented with the level of rates relative to inflation in America, are looking to come to India. But there is another flow, which you've highlighted here, which could be FDI, as we begin to construct a world which is less reliant on China. I wouldn't like to forecast what percentage of that India will get, but the point is it will get some of it, and some of it is important for India. India has struggled for a long time, used to struggle to be not attract enough capital. So anything that adds to attracting enough, and perhaps I still stick to the case that likely it's going to attract too much, but the changing China relationship definitely plays into the ability of India to attract more capital.
In the Asian financial crisis, unless I'm very wrong, you were assessing when the unsustainable credit cycle would end. Now, what about now? What lessons can be or parallels can be drawn from there to what's happening currently and the impact thereof on EMs? You've spoken about the good part. What about some of the tough measures or tough points?
Okay, but we're talking about the whole globe now, and I said the whole point about this book is divide the world into two bits, which is those bits affected by exchange rate management and those that aren't. So those that aren't, and that is the entire developed world, have got excessive credit cycles. I mean, that's why it's got record high debt to GDP ratios. And the only way to deal with that is high inflation. So that doesn't bring everything to a grinding halt. I mean, this is not a collapse. as long as interest rates aren't allowed to rise to reflect the higher inflation, that is the plan. It's a move towards financial repression. That doesn't mean to say that equities go up forever. What it means is eventually you have to force savings institutions to hold this yield curve down. And when you force the savings institutions to buy this government debt, they sell equities and it comes down. But that's a very different mechanism from the traditional cyclical credit grows, credit collapses. That's not what I think is going to happen in the West at all. It's a much more long-term, insidious negative impact as you force savings institutions to sell equities and buy bonds. But to be clear, none of that necessarily has to happen in the emerging markets. I think it'll be seen as a good thing. Interest rates will rise. Credit will slow. It may not necessarily be good for asset markets and emerging markets in the short run, but it remains a pure system, and that pure system continues to attract capital. So it's not the kind of boom bust scenario. Repression is something very different from boom bust, because boom bust is usually 2 years. This repression that the West is getting is going to last 15 years, because it would take about 15 years to get debt to GDP to a low level. India may have to see sharply higher interest rates to contain inflation. That's a problem for 1.5 to 2 years. But the structure of India remains in a much more attractive basis. So the timeline here is very important, but it's not your classic boom bust, because actually repression is there to stop there being a bust, because they realize the consequences of high interest rates in the West. So it's a more difficult and insidious system. And as I said, your viewers should think of the West slipping into a licensed rage rather than a 1929-1932 collapse.
What should EM investors brace themselves for? What in the current context would worry you tremendously for an EM investor, having looked at both 1997 and even 2007, wherein there were tendencies to overshoot and issues thereof?
Well, in terms of just looking for triggers, I mean, obviously the problem is we've got this excessive debt thing, so now you have to look for triggers. And one trigger would be a flexible Chinese exchange rate. I've been saying it's going to happen for quite a long time. It hasn't happened yet. It may not happen for 2 years. It might happen in 2 months. But when it happens, the Chinese step away from their exchange rate, so they have a truly genuine, completely independent monetary policy, then I think we all realize it's going to fall. Now, on that day, I think the markets will be incredibly terrified of deflation and of China wreaking havoc upon the world, because one of the things about this, but it gives me a chance to wave it around, of course, now. So is that one of the great things lying behind the Asian financial crisis was the devaluation of the Chinese currency of '94, and it decimated. There's lots of ways I go in through the book how it decimated the Asian financial markets. It took a while, but it happened. But anyway, that's one lesson from the Asian financial crisis. I think that people would instantly jump on. Oh my goodness, the Chinese currency is falling, incredibly bad for emerging markets. And I'm sure we would see a major slump in Indian equities and all emerging market equities. Now, in my opinion, that would be a wonderful buying opportunity. This isn't going to bring deflation, because China's too big an economy today. It wouldn't be allowed to export all these cheap products and undermine Indian manufacturers. And ultimately, it's doing this to print more money and have higher nominal GDP growth and higher inflation anyway. And then finally, it would really be the very clear start of a Cold War, where that capital realignment we've already discussed would accelerate, and it wouldn't be flowing into China. So, the bad news is that the real trigger, I think, is that, and that would bring the markets down steeply. But I think that would be a wonderful buying opportunity.